Modern banking services extend far beyond basic accounts and are crucial for smart money management. Online and mobile banking allow you to deposit checks remotely and pay bills electronically, saving time. Take advantage of tools like budgeting apps offered by many banks, which categorize your spending automatically. For important payments, use your bank's bill pay service for secure, track transactions. Always enable two-factor authentication on your banking apps for security. Be wary of phishing scams. Your bank will never call or email asking for your password or full social security number. A savings account is designed for storing money for emergencies or future goals. Unlike checking accounts, savings accounts earn interest, allowing your money to grow modestly over time. Federal regulation limits certain withdrawals from savings accounts to 6 per month. To build savings effectively, automate the process by setting up an automatic transfer each payday. This pay-yourself-first approach makes saving effortless. It prioritizes your financial security before you have a chance to spend the money elsewhere. A checking account is your financial hub for daily transactions. It's where your paycheck is deposited, and from which you pay bills and make debit card purchases. The key to managing a checking account is avoiding overdrafts and their costly fees. Set up low balance alerts and consider linking a savings account for overdraft protection. Always monitor your balance and pending transactions regularly. Some holds, like at gas stations, can be larger than the final charge, affecting your available balance. Responsible credit use means leveraging credit to build a strong financial profile without overextending yourself. Pay every bill on time. Set up autopay for at least the minimum due. Keep your credit utilization ratio below 30% on each card, and overall, lower is better. Only apply for new credit when necessary, as hard inquiries can temporarily dip your score. A long history of responsible use demonstrates reliability. Good credit can affect your ability to rent an apartment, get insurance, and even land certain jobs. Your credit report is the detailed ledger behind your score, compiled by 3 major bureaus. It lists your credit accounts, payment history, loan balances, and public records. Review your reports regularly for errors or signs of identity theft. You are entitled to 1 free copy from each bureau every year at annualcreditreport.com. Stagger your requests throughout the year to monitor your credit continuously. If you find an error, dispute it directly with the bureau. They are legally required to investigate. Your credit score is a 3-digit number lenders use to gauge your risk. The higher your score, the more trustworthy you appear, impacting the interest rates you're offered. This number is calculated from your credit report. Key factors include your payment history, amounts owed, length of credit history, new credit, and your credit mix. You can check your score for free through many bank apps or services like Credit Karma. For the exact score a lender might see, you may need to purchase it from myfico.com. For long-term goals like retirement, use tax-advantaged accounts. Common options are employer-sponsored plans like a 401k and individual accounts like an IRA. Contributions to a traditional 401k or IRA are often made with pre-tax dollars, reducing your taxable income now. You'll pay tax when you withdraw in retirement. Roth accounts are funded with after-tax money. Your investments grow tax-free, and qualified withdrawals in retirement are also tax-free, providing valuable future flexibility. To avoid picking individual stocks, many investors turn to mutual funds and exchange-traded funds, ETFs. These are pooled vehicles that hold a basket of many securities. Their primary advantage is instant diversification, which significantly reduces your risk. They are practical tools for building a solid investment foundation. Investing begins with understanding stocks and bonds. Stocks represent ownership in a company, offering high growth potential but with higher risk and volatility. Bonds are loans you make to a corporation or government. They are generally lower risk and provide steady income, but with lower growth potential than stocks. Social Security provides a foundation of retirement income based on your lifetime earnings. You can start receiving benefits as early as age 62, but your payment will be reduced. To receive your full benefit, you must wait until your full retirement age. Delaying benefits past this age, up to 70, results in an increased monthly payment for life. Social Security is not designed to replace your entire pre-retirement income. It's meant to supplement your personal savings from accounts like 401ks and IRAs. A 401k is a powerful retirement tool offering tax advantages and often an employer match. Always contribute enough to get your employer's full matching contribution. It's free money. Contributions to a traditional 401k reduce your current taxable income. The investments grow tax-deferred until you withdraw the money in retirement. Be aware of annual contribution limits and that withdrawals before age 59.5 typically incur a 10% penalty plus income taxes. Let this money grow undisturbed for your future. Homeowners or renters insurance protects your dwelling and belongings. For homeowners, ensure your dwelling coverage is enough to rebuild your home at current construction costs. Liability protection is crucial, covering you if someone is injured on your property. Renter's insurance is affordable and covers your personal property and liability. For auto insurance, liability coverage pays for damage you cause to others. State minimums are often too low. Increasing these limits is a smart financial habit. Health insurance is a critical component of your financial safety net. Key terms include the premium, deductible, co-pays, and co-insurance. Always check if your preferred doctors are in network to avoid higher charges. Adequate health coverage protects you from catastrophic medical debt. Estate planning dictates what happens to your assets and dependents. At a minimum, create a will to specify asset distribution and name guardians for minor children. Establish durable powers of attorney for finances and healthcare. This ensures someone you trust can make decisions if you become incapacitated. Regularly review and update the beneficiaries on your retirement accounts and life insurance policies. These designations typically override what is stated in a will. Putting it all together requires integrating daily habits with long-term goals. Automate savings transfers right after payday, treating them as non-negotiable expenses. Schedule an annual financial review to reassess your budget and rebalance your portfolio. This holistic approach ensures daily discipline fuels your long-term security.